Hello and welcome to our mid-year outlook on the economy and investment markets on the Capital Stewards podcast channel. If we haven't met yet, my name is Brian C. and I'm glad that you're joining us. There's a lot to get to today. We're going to talk about tariffs, the conflict in the Middle East, whether or not we see a recession brewing, the big, beautiful tax bill, and of course, stocks and bonds and all kinds of other investment assets. So if you're joining through the podcast feed, whether you listen on Apple or Spotify, wherever you join on the podcast, there's a lot of charts in this episode. In these quarterly outlooks that we do, I put a lot of charts in there to make it easy to digest. So think about watching the recording on YouTube so you can see the charts. All right, so with that, let's dive into the economy and markets as we move into the second half of 2025. Let's start with what's happened so far this year. On the chart, you can see that gold remains the top asset class for the year, and now it's up more than 23% for the year. That's followed by international stocks, up north of 17%. Bonds have returned just 2.6% so far this year, and the S&P 500 bringing up the rear at just 2.25% so far this year. That's why diversification and owning lots of different assets in your portfolio is really, really important, not just theoretically so, not just to manage risk or to have better Sharpe ratios or some of the things 60-40, some of the things we talk about in investing, but because we can generate returns with lots of different kinds of assets. That brings us more stable, more predictable returns over the long term. We're going to talk about that a lot today, but that's what's happened so far this year. As we always do, it's important not to get lost in short-term thinking when you have long-term investment goals. The next chart shows long-term historical average asset returns for various asset classes. The S&P 500 remains the best performing long-term asset class with returns that are annualizing about 9.8% a year. Gold, after a decade of almost no returns in the 20 teens, has had a big run the last few years and is growing 8% annually. Bonds are up 4% each year. And despite all the headlines around inflation, inflation is just up 2.5% on an annualized basis over the last few decades. When we zoom in a little bit and just look at the past 10 years, the S&P 500 has returned more than 13% on average each year. Gold is now averaging more than 10% a year. Real estate up 6%. The bonds are actually the laggard as rates have risen, only up 1.6% a year. So as we talk about our outlook for the economy, geopolitical events, politics, markets, all the things we're going to cover in the rest of this episode as we think sort of in the medium term about what might happen, keep in mind that we have had all kinds of major events over the past few decades. You would be a very happy investor today if you invested at the peak of the markets right before the global financial crisis, right before COVID, or right before any number of bad news cycles over the last couple of decades, even the last decade right before COVID. So managing risk and diversification is very important, but so is making sure that your starting point is a portfolio that will accomplish your long-term goals. So think about your investment portfolio and your other assets, whether you feel comfortable, regardless of the environment, good or bad, sticking with it going forward. And if you have concerns, that's the key thing that you should think about. If you've got concerns about whether you can stick with it over the long term, and if you're worried about what, things that are on the horizon, events, whatever, are going to do to your portfolio, that's a really good indicator that you probably should seek out some professional advice. At the beginning of the year, I made the case that returns would be harder to generate than we saw in 2023 and 2024, and that's so far been true, with perhaps the exception being gold. Geopolitical events have made the environment only even more cloudy than it was at the beginning of the year. So let's take a look at where the U.S. economy stands today, and then we can dive into the impact of tariffs, geopolitical events, the potential for a recession, all of those things. Real GDP, gross domestic product, is how we measure whether the economy is growing larger or contracting, getting smaller. Real GDP, say that 10 times fast, in the first quarter of this year was growing at 2.1%. That's down from about 2.5% in the fourth quarter of last year. You see in the chart the COVID recession of 2020, there was a big spike in GDP growth, so big spike in economic growth. That's on the red line. That also came with a big spike in inflation. That's the green line. And then the Fed raised interest rates to cool off the economy, and we've been in this cooling off period for the last couple of years. Growth and inflation have come down meaningfully from their post-COVID highs because those high Fed interest rates have put the brakes literally on the economy. You can see the Fed funds rate, that green line, remains well above growth and inflation today. We expected first quarter GDP to be negative, and it was, but that was largely due to a big spike in imports ahead of the implementation of tariffs. Remember that imports actually subtract from GDP. I would expect some of that to reverse and show GDP to be stronger than it really was for the next couple of quarters. So it was weaker than it really was in the first quarter. It's going to be stronger than underlying GDP in the coming quarters because of the way that we do the math around a gross domestic product. But a better measure, I think, of underlying growth that sort of gets us away from the vagaries of GDP accounting is simply looking at consumer spending and domestic business investment. You might have heard this called domestic final sales sometimes. Those categories grew at 2.5% in Q1, and that was still pretty solid, frankly, higher than I expected to see. So the starting point for the economy is fairly strong. We've heard from company after company in the first quarter, though, that consumers were more price sensitive. They were being more choosy on things like travel and name brand products. There was a lot of discussion, too, about pull forward spending for things like cars earlier this year. Retail sales so far have been holding in there. They're up 3% over the last year. The last 2 months have been noticeably weaker, though, in some of those categories like cars that experienced that pull forward demand in the first quarter. So we're just starting to see the payback from some of the spending perhaps that happened in the first quarter of the year that we're not going to see going forward. One of the other major supports to the economy over the last couple of years has been spending from high-end consumers. The values of those 401ks, investment accounts, homes, even businesses have increased, and the consumer is more likely to spend when they feel rich. You're more likely to spend when you got a lot of cash burning a hole in your back pocket than you are when you feel like, you don't know where your next dollar is going to come from, right? The market decline after Liberation Day wiped out about $5 trillion of equity value. So that was expected to have a big impact on spending. But now all of that has returned over the last couple of weeks. So those assets are still available to support spending from high-end consumers. So the outlook for spending is okay. It's not great. There's going to be a little bit of hurt from some of the spending that already happened this year that got pulled forward. But we're not headed into a consumer spending cliff. When we look at business activity measures, both the service and goods ISM measures are now below 50. That means activity is declining. So for several years, goods activity has actually been falling, right? That's been a feature of the post-COVID economy. But the service sector in the US, things like travel, personal care, getting your nails done, going to the barbershop, all those kinds of things have held up the economy. Now they're both moving in the wrong direction. So that is definitely something to watch out for as we move into the second half of the year. The labor market is undoubtedly weaker than it was this time last year. We continue to see the payroll numbers moving lower. That means fewer jobs are being created, but there are also fewer people looking for jobs. Some of that has to do with reduced immigration. Some of that is likely U.S. citizens that are leaving the labor market because jobs are getting harder to find. Maybe they're not as attractive, the pay is not as good, benefits aren't as good, those kinds of things. New claims for unemployment insurance are up, but only very slightly since the beginning of the year. It is becoming very difficult for people that are unemployed to find a new job. The rates of job finding are at all-time lows. So over time, the grind of even a small number of layoffs and very few open jobs will raise the unemployment rate. But without a sudden shock, it's kind of like a slow grind. It's not something that causes an imminent recession. You can see from our chart on the right-hand side of the page, because the labor force is getting smaller, the U.S. is continuing to produce enough jobs to satisfy demand. We just keep hanging right around that black line, which is our kind of Mason-Dixon line. It's how we sort of look at, like, if we're above the line, we're okay from an employment perspective. If we're below it, we're in trouble. And we're kind of hanging out right on the line or right above the line. That's okay. In order for job losses to be more severe, we need layoffs to rise materially. What we've seen so far is a lot of companies, the really big companies, announcing a few hundred layoffs, a couple thousand layoffs. When you have 100,000 employees, there's, in excess of 10,000 employees probably leaving your company every year, right? So laying off 500 folks is not really that significant for the entire economy. We're seeing layoffs tick up again a little bit, but it's just very slow compared to history. So again, more evidence of a slow grind down, very similar to where we were and what our outlook was when we started the year. We also hear a lot about the consumer being tapped out. After all, prices are a lot higher than a few years ago, and those consumer credit card balances are at record highs, right? Can that keep going? You can see in the chart the off-cited record levels of consumer debt. Keep in mind, the economy gets larger every year, and so almost every form of debt reaches a new high every economic cycle. So what really matters is debt or debt payments relative to consumer income. You can see that consumer debt to income, so think about that as a credit card payments and the like, that has moved higher from the lows that we saw during COVID, but we're really just sort of back to where we were pre-COVID. We're nowhere near the debt service levels that we saw before the financial crisis in 2008. Same is true with mortgage payments. So this seems more like an equilibrium that can kind of continue in the economy more than it does a major risk that's going to cause consumers to stop spending, sort of abruptly. You may also hear that consumers are being tapped out because prices are higher. They just can't afford to continue to spend. The reality is that wages, especially for blue collar workers, have kept up with inflation over the last 5 years. You can see inflation as measured by the CPI in the red line. It's up a cumulative 25% since COVID. That's a lot. But average hourly earnings have more than kept pace with the employment, with CPI, and the employment cost index, just another way that we look and measure, what we're paying folks. That's only slightly below inflation. So I don't think that consumers are simply going to run out of steam without some sort of shock to the economy. So on its own, this feels like an economy that's going to continue to slow under the pressure of high rates. But in my view, slowing means moving from 2.5% growth, perhaps down to 1% growth. It's not falling off into a recession. In order for us to see a recession, like I said, we need to see layoffs move higher and jobless consumers significantly curtail their spending, and they need to do that, in a fairly dramatic way. So what could cause some kind of shock that would push us into a recession? And as we outlined on Liberation Day in prior episodes of the podcast, those tariffs would have caused prices to rise materially, probably caused a subsequent drop in consumer spending, a bunch of layoffs. So that probably would have caused a recession. Consumers just wouldn't have been able to afford goods at those prices. However, President Trump and the rest of the administration has walked back the most severe tariffs, and more deals seem to be forthcoming. So let's look at a couple of facts around trade to get to sort of a baseline understanding before we get into kind of where we go from here from a tariff perspective. In 2014, the U.S. exported $3.9 trillion in goods and services. We hear a lot about the goods trade deficit. We export both goods and services. We exported 3.1 trillion. We imported about 4.1 trillion. There's some rounding in there. That leaves about a $900 billion trade deficit. So trade generally is important, but many of the items that the U.S. exports, like I said, they're services. They don't come from factories. So just keep that in mind when you're having conversations about trade and sort of the import-export balance. We do export a lot of things. They're just not stuff that gets made in a factory and put on a boat. The other thing to keep in mind is that because we do import more than we export, foreign countries have the dollars, the profits, if you will, from those transactions. They invest those dollars back into the United States. There's currently more than $30 trillion of foreign capital invested into the U.S. That's something the U.S. Treasury tracks. About half of that, so 16 trillion, is in the stock market. And the remainder is in various kinds of bonds, and only about 6 trillion of that's in treasuries. I think people assume it's a lot of treasuries. Only about $6 trillion of foreign money in the treasury market. So every year we run a trade deficit, foreign holdings of U.S. securities increase. So if we were to stop trade, the reverse would happen and U.S. asset prices would go down and probably not by a little bit. So there's, like I said on this chart, there's kind of 4 potential outcomes from, and not by a little bit. So So when we start messing around with trade, it's just very important that we understand all the consequences. It's not just about sort of the trade deficit in goods. It's about the whole picture and what happens to all of those dollars, after sort of a specific transaction is completed. There would be certainly ramifications, even from a jobs perspective, of fewer foreign dollars flowing into the United States. If there's less dollars going in the stock market, there's less M&A happening, there's less, expansion happening in companies and things like that. So there would be some indirect negative things that would certainly happen if you said, hey, we're just going to manufacture everything that we want to have here in the US. There's 4 potential outcomes from the tariff situation. And this is going to in the bottom part of the chart. You can raise revenue. Tariffs, after all, are an import tax. You can protect U.S. industry from foreign competition. That encourages investment in sort of U.S. manufacturing. And that happens that we've had tariffs on certain industries for the entire history of the United States. That's not really a new thing, but that's one thing you can do with tariffs. You can protect strategic industries. So this is where you think about things like pharmaceuticals or certain metals industries, defense, et cetera, where you want to have, you want to make sure that we have access to some products, can build those products here in the U.S., and also that our, geostrategic competitors don't have access to some products. And then lastly, you can use tariffs in negotiation to try to reduce global trade barriers. The problem is the last one is mutually exclusive to the first 3 goals. So, because essentially what the negotiations mean is that you're going to start with a higher rate, you're going to lower the rate. So if you lower the rate, you get less revenue, less protection, whether that's protecting an industry from foreign competition or whether it's protecting, something like AI chips from going to China. So you can't both negotiate and raise revenue and all these things at the same time. You have to pick. It's one, or the other. And lastly, despite all the U.S. discussions, U.S. trade is important to China. And this will be different maybe than what you hear in the news, but it's not the end all be all that it was a decade ago. The Chinese have diversified their export base. They don't want a significant hit to GDP growth. That's kind of the CCP's contract, the Chinese Communist Party's contract with their people, is they grow the economy at 5%, and then the Chinese people let them do what they want. But what we've seen is that the U.S. position here is not really strong enough to get the Chinese to come to the negotiating table on bended knee and give the U.S. everything that it wants. The more likely outcome with China, I think, is an off-ramp that gives each country a little bit of what they want, and it doesn't do significant damage to either economy. I think that's more likely where this thing sort of ends up. So going forward, tariff rates are higher, to be sure. The average tariff rate moved from about 4% to 17%, depending on your exact assumptions. That's significant. That's going to cause inflation to go up in the second half of the year. So we've been hearing about inflation that's like 2.5 to 2.8%. It's going to go up to somewhere between 3 and 4% as we go into the second half of the year. But those tariff rates at 17% are far from the 30% that were originally imposed back on Liberation Day. So my view is kind of, some increase in tariffs, probably part of that sort of dull meat grinder lower that we see in the economy, but not likely to be the sole cause of a recession all by itself. Now, if we see snapback tariffs and the negotiations with major trading partners, China and Europe in particular, don't go as well as we're hoping, and we go back to those Liberation Day tariff levels, I think that's where there's sort of real risk. But I think as we see things, as things stand today, I think the administration, I think Trump doesn't want a recession, so they're going to kind of take some wins where they can get them, talk about those, and try to exit without major consequences for the economy. Two things I don't see as major risks that you may see as a risk are conflict in the Middle East and the big, beautiful tax bill that's currently working its way through Congress. So let's start with the Middle East. Obviously, a lot going on there. It's June 16th that we're recording, June 18th. Time flies when you're having fun. We're recording this. And so, this could have changed certainly by the time you listen to it. But I wrote a note on this last week for our clients. So you can see that for more detail on sort of the Israel-Iran conflict. The U.S. is not currently directly involved, but that could change at any moment. So first, when we think about most conflicts in the Middle East, Iran's a very small part of the global economy, and the direct investment implications, I think, of a conflict are pretty minimal. The death and destruction are very real, right? That's saddening. Nobody wants war, but Iran's initial response seems to be pretty weak. Their ability to wage a war long term is pretty limited. So even a full regime change in Iran is not something that's going to impact global economics in a really significant way directly. There is some indirect risk, and that relates to oil prices and natural gas production. Iran only produces about 4% of the world's daily oil supply, but about 25% of that global supply travels through the Strait of Hormuz off its coast. So if you were to close the strait, if Iran were to try to close the strait, that would result in oil prices probably temporarily going up over $100 a barrel from somewhere in the 70s today. That's a pretty big increase pretty quickly. The risk of that occurring is probably pretty low. I think that's a situation where the U.S. and other countries would step in to ensure passage of ships, particularly oil tankers, through the strait. So the likelihood of that, sort of kind of shock continuing for weeks and weeks is probably pretty limited. So I think global markets will sort of revert to trading back on global economic activity, interest rates, all those kinds of things after the conflict subsides. Let's talk a little bit about the tax bill. And before we get to the current legislation, kind of like trade, I want to set the sort of table on sort of the U.S. fiscal situation correctly. I think most people get their information on the U.S. fiscal situation from the news, and that's usually tilted one way or the other, left or right. So there are two things that are true about the U.S. fiscal situation. The first is that we have a spending problem relative to our history, not a revenue or tax collection problem. You can see on the chart, U.S. revenue has been very steady, about 17% of GDP since the 1940s, and that's where we sit today. That's the green line on the chart. Spending, however, exploded higher during the financial crisis in 2008, and that would have been okay had it come back down, but it didn't. Then it exploded again during COVID, and it continues to move higher. Spending should be somewhere between 18 and 20% during good economic times. We don't have to have a completely balanced budget, but we should be closer than not during good economic times so that we can spend to stimulate the economy when things go south. So you can argue that we should raise tax revenue to a higher level than it's ever been. That's a political argument. You can argue that we should have even more spending than we have now. That's also a political argument. But you can't argue with the current levels of either relative to the size of the economy and history. The second annual discussion that's coming up later this summer is going to be around who pays and doesn't pay their fair share of taxes. I'm telling you, this is coming to a news program near you in a month when the Senate gets done working on this legislation. So let's look at the tax data. Let's look at the tape, right? These charts show the U.S. households and what they're paying in taxes broken up by income quintile. You can see on the bottom row the dividing lines between the 5 income groups. So on the left, the lowest 4 quintiles, you can see that those lowest 4 quintiles, they all have a higher share of income than they pay in taxes. The only group that shoulders a greater burden of taxes than their share of income is the richest 20% of Americans. They pay 81% of the taxes and they only earn 55% of the income. You might ask how it's possible to have a negative share of taxes and a negative tax rate. That's because this takes into account refundable credits and deductions. So you can get back more from the government in income taxes than you pay. That happens in the lowest quintile. It's not necessarily a bad thing, but that's how that works. You can also see on the right side of this page that the average tax rate for the highest earners is higher than all the other groups. The secretary does not pay a higher tax rate on average than her boss. There is always one-off exceptions when you have really highly paid secretaries, but that's not something that happens in the world for most people. You can make a political argument that the richest quintile should pay an even higher rate or an even higher share of the taxes. That's a logical argument. You might agree or disagree with that. You can make an argument that the tax burden should be shouldered more evenly across income groups. That's a logical argument. But you can't say that the top earners don't pay their fair share or their proportionate share, because objectively, they're the only group that pays more than their fair share of the taxes in the United States. So that's where we are as a starting point. Again, you can think about taxes whatever you want. Should they be higher, lower? That's going to be a political question, not really an economic question. But I just think it's important that everybody, when we talk about taxes, starts with sort of some reality and sort of where things are, and not starting from a position that's just not accurate, to formulate your own views. So, all right, so now that we have a starting point, let's talk about the tax bill. I'm not going to cover every proposal in the bill, what it's going to do to your personal taxes. We'll do a whole podcast once all the sausage making is done, because I think that's going to change a little bit between now and the end of the month. And so this will be pretty dated by the time with all the changes. So we're not going to cover every provision from a tax planning standpoint. Look for that coming forward, later this quarter. What we are going to talk about is the impact on the economy. So does the government spend more money in 2026 after the bill is passed than it did this year? Does the government collect more or less in taxes than it does in 2025? And the best consolidated view of that is the deficit. So we're currently projected to run a federal deficit of about $1.9 trillion in 2025. That means we're going to spend almost $2 trillion more than we bring in revenue, and we'll borrow that money. The big, beautiful bill does reduce spending levels. That's what the administration claims, and it's true. According to the CBO, spending goes down by about $175 billion a year. Now, on the revenue side, the proposed tax cuts are going to reduce revenue by $557 billion a year in 2026, and then $571 billion in 2027. Over the next decade, taxes are reduced somewhere between $3.5 and $4 trillion. So that means in 2026 and 2027, the deficit's going to increase by $542 billion in 26, and then in 27, another $522 billion. So altogether, we've got deficit increases happening. That's that $2.6 trillion number you hear about coming over the next decade. So from an economic growth perspective, that's good. The government is spending slightly less money than it did in 2025, but it's collecting way less in taxes. So the net effect should be stimulative for the economy. That deficit number goes up. But what that doesn't account for is the deficit. The cost of that near-term economic growth is more debt and deficits over the long term. So you've heard that the CBO, the way they do math is archaic, it's strange, it doesn't account for everything, tariffs, all that kind of stuff. So for this conversation, I just looked at this year's budget and what's the impact going forward. No exemptions, things that would have happened, baselines, glide paths, none of that stuff. Do we spend more or do we spend less? Period. So we're gonna spend less money, but we're gonna take in a lot less in taxes. That's stimulative for the economy on its face. That still leaves out the tariff revenue. And you might ask, well, won't that cover some of the costs from the bill and make that deficit lower? It is true that if the April 2nd tariffs, if those Liberation Day tariffs were left in place, they would raise about $1.4 trillion over the next decade. By the way, that's not enough to pay for the bill to start with. Remember, $2.6 billion increase in the deficit, $1.4 trillion in tariffs. So you still have a gap there. But it would raise more than $1 trillion in revenue. So that's a good thing from a deficit standpoint. But the reality is, since April, the president has been negotiating rates. What direction? Lower, right? We talked about this previously. You can't both get revenue from the tariffs and then also use them as a negotiation tool to get things that you want in the global economy. So the reality is that the rates were so high that they were hurting the economy. They were going to hurt the economy. So it's more likely that tariff rates are going to be sort of where they are today in that 17% range. That means we're going to have maybe $500 billion of new revenue from tariffs over a decade. So we are going to get some revenue, but it's not going to come close to sort of paying for the tax cuts that are out there. Again, that's not necessarily a bad thing. It's stimulative for the economy, but it's not going to help solve the debt and deficit problem that the U.S. faces over the long term. So in short, I think it's likely that we see the economy continue to slow throughout 2025, perhaps not fall into a recession. Think 1% growth, 3.5% to 4% inflation as tariffs take hold in the second half. So given that as the economic backdrop, let's look at investment assets. So we'll start with stocks and bonds and then we'll move to gold and real estate and a couple of other things. So I start with stocks mostly because equity exposure generally forms the bulk of portfolios that are aimed at long-term growth. When we think about portfolio construction, the major question is really how much stock exposure should we have? Equity stocks, both public and private, provided that's where the bulk of your portfolio returns come from over the long term. After that important question is answered, then you can fill in the rest of your portfolio with diversification. So stocks should, and they do, track their earnings over the long term. As the earnings, the profits of those companies grow, stock market grows. Companies make more money, stock prices go higher, pretty simple. You can see in the chart that earnings are in green, the S&P 500 price is in red. We started this year with analysts expecting a 14% earnings growth. As I mentioned, the 2025 outlook, I thought that was pretty optimistic. Everything had to go right in order for earnings to grow that much. Obviously, now everything is not going right. We have global conflicts, we have trade and tariff issues, we have all kinds of things going on. What's funny about earnings expectations, so they've dropped down now to about 7.5% for the year, according to Bloomberg. So we've gone from expecting companies to grow profits at 14% to expecting them to grow profits at 7.5%. The market is higher than it was at the beginning of the year. And you can see in the chart, the market continues to grow faster than earnings. That's causing price earnings multiples to go higher, making the US stock market expensive, particularly the S&P 500 in our view. So corporate growth is currently expected to be only about 4.5% in the second quarter. That's the analyst consensus. And given kind of that slow grind that we've talked about now at length, I don't see how profits meaningfully accelerate from there in the second half of the year to even get into that, sort of 7 to 9% range. So what's been working in the US is a tilt towards growth. That has been the case for several years. The economy is slowing down, but some companies, so think AI, tech, et cetera, they're still able to grow their businesses despite overall sluggishness in the economy. So in the US, I think sticking with growth in a slowing environment is still the right approach in my view. Overall, the stock market is expensive. And the earnings outlook isn't great going forward. So we need to find better opportunities, I think, to generate investment growth for the balance of the year. The good news is we have a lot of other choices. Rates are higher. It's not sort of equities or nothing else, right? In the stock market, international stocks have by far been the best performer so far this year in both developed markets like Europe and Japan and emerging markets like China, Brazil, Poland. Yes, even the Chinese stock market. The good news is that we have lots of other choices. In the stock market, international stocks have by far been the best performer this year. Both developed markets like Europe and Japan and emerging markets like China, Brazil, think Poland even. Yes, even the Chinese stock market is up 17% for the year, despite all the tariff conversation. You probably didn't hear that in the news. Do I think the US is losing its position as the main driver of global economic growth? No. I think the US will continue to be the best place for long-term growth, the best place for innovation, et cetera. But can international assets outperform US stocks when the US has, anemic economic growth expectations near term and really high stock valuations? Absolutely. And that's what we've seen so far this year. We got surprise fiscal stimulus from Europe earlier in the year so they could spend more on defense, maybe borrow a little bit more money in Germany. The run-up in developed international markets has corrected what was probably a discount to their long-term valuation. So they were super cheap. Now they're kind of average, right, from a valuation standpoint. So they're not on sale, but they're not overvalued like the US. And so even if they have sort of slow growth in Europe, which is kind of the expectation, at least we're paying less for that future earning stream. Let's talk about emerging markets. Growth in the US and much of Europe is anemic, but there's other areas of the globe that are still pretty attractive. India is growing at 7.5% year over year. Inflation is now down below 3%. China's still projected to grow between 3 and 5% this year, depending on the outcome of trade negotiations. So when we think about emerging markets, my view continues to be that buying specific countries and assets that are attractive is the way to go versus owning the entire index. That's one of the few places where active management still seems to pay off. Exports do drive most of the economic growth in the emerging world. So there is some risk there that the trade war heats back up. So owning companies that can win domestically within their markets in EM countries is probably a better bet than those that are solely reliant on exports to the US or to China for that matter. A lot of other emerging markets export things to China. So moving on a little bit from stocks, let's talk about the diversification part of portfolios, perhaps never more valuable than the present. Before we dive into asset classes, I think it's worth pointing out that these asset classes are doing the work really in portfolios this year. The S&P, like I said, it's up a little more than 1%, almost 2% year to date. Gold's up more than 23%, right? We just talked about international stocks already, but bonds are also outperforming the stock market so far this year and with much lower volatility and risk. So let's start with bonds and interest rates. Intermediate term bonds, that's kind of the core of your bond portfolio, right? That's up 3.6% so far for the year. Not bad. We're halfway through the year. Interest rate volatility has been very high, but ultimately longer term bonds have not fared sort of as well as the intermediate part of the curve or those bonds that are, think 4 to 6 years in maturity. You see those longer term bonds in the pink line, they're just up 1.4% for the year. So it's definitely been an intermediate term bond story. High yield bonds backed by corporations and bonds from emerging market countries have been the best performers so far this year. Those have been a staple of our bond portfolios for the last few years. So as long as we stay out of a significant recession and credit crunch, which is kind of our expectation, then those bonds should continue to kind of lead the pack. I do think it's worth noting that floating rate high yield bonds are among the worst performers this year. That's a really good proxy for private debt. The companies that issue high yield bonds that trade in public markets, they have fixed rates once those bonds start trading. And those companies have continued to pay their interest and principal over time. As rates have risen over the last couple of years, companies that have variable interest rate structures in those floating rate funds and in private debt have had more challenges as rates sort of ratchet up on them incrementally. So there isn't a huge crisis brewing at the moment, but I do think there's a lot of kick the can kind of happening in that space. Stop paying interest, stop making payments, add things to principal, all those kinds of things. And if rates don't come back down, some of those companies with floating rate debt are going to run out of rope. They're not going to be able to play kick the can anymore. So I do think that's something to watch out for. Even in the high yield space, like I said, I like that in general, but I would stick to fixed rate stuff that's publicly traded versus the variable rate markets at this point. The next chart shows fixed income assets based on yield. I put this in here just to reaffirm the point that a diversified portfolio can help you accomplish your investment goals. Stocks don't have to do all the work. Certainly high yield bonds yielding 6.5% or more, that helps. But even investment grade credit in the 4 to 5% range goes a long way to building portfolio returns when your targets are just 6 to 8% a year, right? Most of your financial planning goals, that's kind of what your long-term averages are. If we can get half of that or more in a bond portfolio, that's a pretty good starting point. We started the year with markets expecting 2 Fed rate cuts, kind of sticky inflation, and of course, GDP and really strong earnings growth. The market is back to pricing in 1 to 2 rate cuts this year. We had a Fed meeting today where they said a whole lot of nothing. That's probably more realistic than honestly the 1 to 2 cuts for the remainder of the year than my original expectation of 4. Make no bones about it. The Fed should be cutting rates with the economic growth softening. The problem is tariff rates have been higher than anybody expected. That's going to drive inflation meaningfully higher in Q3 and Q4. But without really serious layoffs picking up, it's really hard to see the Fed cutting rates significantly as we go through the balance of the year. So the result is that rates are going to continue to put downward pressure on the economy. And by the time the Fed cuts, even if it's early 2026, it might be too late. We talked about it this year. We kind of framed this year as maybe the Fed making a policy mistake and not cutting soon enough because tariffs were going to be difficult to contend with. And I think that's been the case so far. That's probably going to make us worse off in the long term, but that's the situation that we find ourselves in. We already covered the big, beautiful bill and the deficit, but the bond market, it's definitely now trading with two sort of distinct sets of data. You can see in the yield curve, the red line is the curve from last June, and the green line is where we stand today. Short-term rates have moved lower over the last 12 months as the Fed sort of cut rates, the economy is softening, et cetera. That's moving based on economic data. But long-term rates have been more stable, maybe even up a little bit. And that's because those longer term bonds are trading less on the near term economy and more on expectations around the US fiscal situation. So when you put that big beautiful bill out there and you have a continued deficit expansion, longer term investors in the treasury say, I'm at the margin maybe less interested in owning this. So continued expansion, the deficit is keeping those long-term rates higher than they probably would otherwise be. I think short-term rates do eventually come down closer to 3%. That's been my view for a while. That could lead the 10-year, though, trading somewhere close to today's levels, between 4.25% and 4.75%. That makes longer-term bonds, especially treasuries, less attractive today in our view, versus corporate bonds, because we can earn higher rates today on those corporate bonds versus waiting for interest rates to collapse in a recession that might just never quite arrive. We'll see. So what about assets outside of bonds? Gold has provided really strong returns in a challenging environment. It's up more than 20% for the year, like we said at the beginning. My overall view on gold hasn't changed. As long as central bank demand remains above average, which it has, then gold should continue to do well. You can see that central bank demand on the chart, it's on the right-hand side of the page. It came off a little bit in the first quarter, but it still remains above that 200 ton a quarter level. That should at least keep prices sort of stable, if not increase them a little bit. This year, we've also seen inflows from investors on that chart on the left-hand side. We get a little bit of market volatility, some geopolitical uncertainty. What does everybody do? They go buy gold. You see in the chart on the left-hand side, that blue bar, it sort of appears out of nowhere in the first quarter of 2025. That's gold ETF demand, which shot up. Financial demand for gold tends to be really finicky. Traders move in and out quickly. So I expect some of the increases we saw in the first half to kind of reverse as we get into the second half of the year. So overall, we may have seen most of the total return for gold that we're going to get in 2025 already. But gold is one of the best hedges in this kind of stagflationary environment that we find ourselves in. So I think continuing to own gold makes sense for now. Just be a little bit judicious about adding more at this point. So let's round out this conversation with real estate. U.S. home prices are starting to flatten out in the Case-Shiller data after years of upward momentum. Technically, prices are still up about 3% year over year, but in many markets, I suspect prices have actually already started to fall a little bit. The data just lags a couple of months. That's certainly true in Huntsville, where we are. If you look at the existing home market, we've been stuck at about 4 million sales a month, and the number of homes on the market has been gradually rising. That makes it more and more of a buyer's market, and that should start to lower prices over time, even if only sort of modestly so. Sales at new home builders have also been down, and a lot of those new home builders haven't cut prices directly, but they've been adding incentives to new home purchases, the rate buy downs, free upgrades, all that kind of stuff. That stuff acts like price cuts. So you can see in the home builder sentiment data, it's basically it's kind of in the basement of the house, right? It's the worst environment really that we've seen from a home builder perspective since 2008. Traffic is down. Future expectations are also very weak. So homes are still a good asset to own, right? When we talk about financial planning conversations, completely different conversation when we're talking about trade-off between owning a house and renting. But being choosy on specific houses and markets, I think, where we are today is important. From an investment perspective, apartment vacancies are also rising as more new units come online. So rents are flat to down as well. That makes it harder to make investment rental property, short-term rentals, all those kinds of things. Makes it harder, for new investments in that space with higher interest rates to work well. You've got a high-cost mortgage, lots of competition, lots of availability. So if you can find a good property on sale because the price has come down a lot, it might work. But otherwise, I think it's prudent to kind of sit tight and wait for a little bit better rate and rental environment before you're making a bunch of investments in sort of the residential real estate space. So we've covered a lot of ground, so I'll try to summarize it all and tie it up neatly in a bow here for us at the end. We've gone round trip so far this year. We've started the year looking for stagflation. Then we moved into a recession around Liberation Day. And now we're back to that sort of stagflationary environment that we expected at the beginning of the year. Growth is still positive, but it's slowing down. I expect it to remain that way for the next 6 months or so as we round out the year. Inflation likely going to rise a little bit given the impacts of tariffs on consumers. The biggest risk is that the tariff discussion heats back up and we get substantially higher tariff rates that kick in, not just a little bit higher, but a lot higher. That would drive prices up, drive down growth more quickly than the market or I currently expect. US stocks look expensive in that environment. The rest of the world just looks to be a little bit better when you think both growth and valuation. If I can get slow growth at a cheaper price somewhere else, maybe I do that outside the US. In markets like these with a lot of uncertainty, I think that's where diversification really matters. And not just, I kind of hinted at this earlier, not just in a theoretical sense. Everyone always says be diversified, manage risk. That's easy. You've heard that a million times. That's important. I'm not saying it's not important, but in this environment where you can generate similar single digit returns across a lot of different asset classes, I think you're far better off owning a lot of different kinds of assets than just depending on one asset class like stocks to drive your portfolio's growth, like what we've seen over the last 4 or 5 years. Stocks, bonds, gold, real estate, infrastructure. There's other stuff out there too that can help drive returns. And some of those assets are likely to outperform no matter which way the economy breaks. So diversification is really key to navigating this market, perhaps in a way that it hasn't been in recent years. So I hope all this perspective on markets has been helpful as you think about the rest of 2025. If you have questions about your investments, if you'd like to talk about anything further, I'm always happy to connect. There's a link to schedule time in the show notes. So happy to do that and look forward to talking to you all very soon.